Hello everybody, and welcome how to pay off your mortgage 5 to 10 years early. I should have warned you all in advance. You're probably going to need to take some notes. So I'm going to give you a few minutes to grab a pen and paper or a pad and just ramble for a bit. Basically, we can do this with no additional money out of your pocket or changes to your lifestyle. Usually what we can do is save a family or improve their cash flow so they can do this without taking any additional money out of their pocket by $3,000 to $6,000 a year. And we'll give you a couple of ideas on how to do that. Of course, there are many more. Essentially, what we're doing is we are teaching families how money really works in America today so you can take advantage of it and get the most out of your money. Okay, I'm hoping everybody's back so we can move on. This is a workshop for educational purposes only. Our goals are to provide every family with the strategies and help they need to be debt-free. If you don't have debt, it's easier to accumulate the money to pay off your mortgage earlier. Establish an emergency fund. That helps you stay out of debt. Pay off your mortgage 5 to 10 years early. Fund a college education if you have children. Maximize your retirement income and achieve financial security. Now, growing up, we were all taught about the American dream. They kept on telling us, go to college, get a good job, buy a house, pay off the mortgage ASAP, and save a little each month. And you'll be set for life. Is that true today? It used to be rock solid advice for our grandparents and our great-grandparents. They lived in the same house for life. Had only one job their entire life. Lived on one income. Retired with a pension. Anybody here remember those? They were replaced with 401ks, and I'm not exactly a fan of a 401k, but that's another story. They had no credit card debt. They saved a little money consistently, and they could count on Social Security. Anybody here tell me when Social Security is expected to become insolvent? I guess I forgot to tell some of you, you do have a chat feature, and I'd appreciate it if we could make this a little bit more interactive. You can answer questions. Maybe throw up a question, I'll answer it as I go along, if I can. Okay, so anybody here know when Social Security is slated to become insolvent, when it's expected? Number I hear, the year I hear is 2035. Now, I'm planning on still being here, and I think all of you are too, so. Oh, we missed something. I'm sorry, let me go back. So we can't count on Social Security, and we planned on only being retired for a few years. People are living longer, and I'm going to go into this in a few minutes because it really is important. But life has changed. It's not the same world our grandparents and our great-grandparents lived in. We're going to move 4 to 6 times in our life. Have 3 to 7 jobs during our lifetime. Need 2 incomes just to live. Never have a pension. Who knows where we can get a pension today? Anybody know of any companies? Now, the companies have all replaced them with 401ks. The reason why I don't like those is because they're subject to market fluctuations. The market goes down, you can lose everything. Or not everything, but we've seen, and we're going to see how the market goes up and down, how you could lose upwards of half of what your money was, and if that's happening when you're about to retire, that can really hurt. Pensions, on the other hand, they weren't invested in that. They had a generally very safe return, and the money was there when you were going to retire. About the only place nobody's been able to figure out where we can get a pension, except for a few of you mentioned the government. But it's only the government now that gives us a pension. This actually, the 401ks that destroyed the pension from companies came out during Jimmy Carter, so we can blame him for that. We struggle with credit card debt. That's what we use for emergencies. We save very little money, and we worry about Social Security being there. Like I said, right now, we think it's still going to be there until 2035. Anybody look at the national debt? That's growing now, especially with the most recent tax cuts. I love tax cuts, but they have to be responsible. And this is going to increase our deficit to over $1 trillion a year. So you think Social Security will be there and somebody will be able to bail it out? Maybe not. We'll be retired for 30 years or more. I've sort of touched on why this is important. Our lifespans are growing longer. Back in my mom's generation and my dad's generation, generally lived up and through, their 60s, maybe into their 70s. My mom had 6 brothers and sisters. They all died in the 70s except for her oldest brother, who died at 85. He outlasted almost everybody there. Now, we're living healthier lifestyles. Medical technology is improving. Who knows what the average lifespan for a man is today? Some people are getting that right off the start, 86. So we're already talking about 20 years of retirement there. How about for a woman? Yep, 88, a few years longer than a man. Some of you got that right. So we're already working on 20 years, and the pace of technological improvement in healthcare and how much better we're living our lifestyles, don't be surprised if by the time we're ready, we're living into our 90s. Now, who here feels they're going to have that kind of money? They're not going to outlive their savings when they retire. That's a reason to pay off your mortgage early, so you own the house, so you don't have that expense when you're older. And there's a few other tricks to the trade. So how do we keep the great American dream alive? Well, there's a few ways. Get back to traditional ways we managed our money. Like cut back on those credit cards and our debt. And there's ways of doing that. Find ways to cut our expenses without changing our lifestyles. And you'd be surprised at how easy that is, and surprised how it might actually improve your lifestyle. Find ways to make all our money and assets work for us. We can't afford to let things just sit. We have to use everything we can because of the change in the world. Establish better priority in our financial lives. And this is part of it. What is the number one problem keeping us from attaining the great American dream? Is it auto loans? How about credit cards? Student loans. That puts us right in the hole to begin with. We're right behind the 8 ball before we even get started in our lives. And then the big one, mortgages. That's probably the biggest expense in our lives and our biggest debt. What do they have all in common? Yep, they're debt. Actually, I think another reason why we can't reach the American dream, taxes. And we'll show you something that can help with that as well. But those are the 2 reasons why there aren't more millionaires. How big a problem is debt? As of 2016, almost 900,000 families filed for bankruptcy. 90% of those families said medical bills and credit card debt were major factors. Credit card debt in the U.S. is just soaring. It's almost quintupled since 1987. Excuse the typo, but that's almost 500%. The average family credit card balance is over $16,000 as of this past December. Average interest rate paid on that debt was 17%. Now, the banks have a nasty trick for you. This is something that I'm sure several of you have gotten hit with. And when I start telling you what it is, let me know if this has happened to you. Pardon me. If you default, fail to make your payment, that interest rate can shoot up to almost 30%. It doesn't matter if you were in the hospital, your car was broken down in Idaho, something happened with your mailbox, or the mailman couldn't deliver the bill. If you make that payment late, or you miss a payment, you can be paying 30%. And some of you may have expected a rate, but you're thinking now, wow, what happened when I missed that payment or when I was late on? So check your credit card statements. Make sure you're still only paying that 17% on that card, or it hasn't gone up to 30%. That could have happened. Some of them take advantage of it and some of them don't. But, it's a nasty surprise. So how much is your debt really costing you? Let's go back to that $16,000 with an interest rate of 17%. That's over $2,700 a year. Now, where would you rather see that money? Would you rather keep on paying that to the bank every year? Or would you rather keep it in your pocket and earning interest? Let's say you save that $2,700 a year each year for 5 years. What would it be worth? That's $13,600 plus interest. I'd say that interest could be over 15. Bring it up to over 15,000. And how about 10 years? That's $27,200 plus interest. So that's over $30,000 you could have had in your pocket. How many years could that have cut off your mortgage? Was it 2 or 3 or 4 years right there? That's a big difference. This is money that doesn't have to go to the bank. What are the other problems that are a direct result of having too much debt? Well, many of us have no savings. 1970, the savings rate was 8%. Today, it's 3.1%. No source of emergency funds besides the credit card. We've already determined what hole credit cards are. Now, what's the first rule when you find yourself in a hole? Stop digging. Yeah, some of you got that. Basically, you need to establish an emergency fund. And, finding different ways of prioritizing your spending. Like I showed you about the credit card interest. You can build that emergency fund. Lack of insurance. At some point or another, all of us are going to need insurance. Most notably, health insurance. Do you have any idea of how expensive insurance is? What it does not, healthcare, not insurance. Yes, insurance is expensive too, but it's the lesser of the evils. Getting sick, being injured can cost you a fortune if you don't have insurance. And even if you do, because there's a lot of things that are not covered, such as if you are injured someplace and you have to go to an out-of-network hospital. Sorry about that. So if you have to go to an out-of-network hospital, they may not cover 20 to 30% of that bill. There's other things that they're denying, if it's experimental or there isn't enough evidence on it. So you could be left with tens of hundreds of thousands of dollars in debt if you don't have insurance. Future planning problems. No college funds for the kids if you have them. Hopefully we're all going to retire. We're going to live that long. And there's no planning for that. You're going to have to work the rest of your lives unless we can help you eliminate your debt and start saving money. Now, what if you could reduce and eliminate all your debt without taking any additional money out of your pocket or changing your current lifestyle? Yeah, we can do that. I mentioned earlier at the beginning. Pardon me, I need a little drink. I mentioned at the beginning how we can help families save, or not necessarily save, but improve their cash flow, $3,000 to $6,000 a year. So that money can go towards your futures rather than, let's say, to the bank. So here's some examples about how you can improve your cash flow. How do you quickly reduce and eliminate your debt? Identify money that you may be spending unnecessarily or in the wrong places, like your mortgage. We'll show you how not to spend on the mortgage and how you can put it towards other things, like paying off your mortgage early, saving for your child's education, retirement, whatever. But if you can pay off your mortgage early, you don't have to worry about that expense in your old age. Find and use credit cards with lower rates. There's a lot of credit cards out there now with teaser rates, 0% for 15 or 24 months. And also you can have balance transfer cards where it costs you 2 or 3% to transfer the balance to a card. So you can save quite a bit of money that way. Combine your credit card balances. Use equity lines of credit to pay off your debt. I have a client who was an antique dealer, and he's looking to get back into that. But 2008, that market crash, the bottom of the antique industry fell out. They became worth a lot less money. Now, what he did was he used his equity in that property to borrow money to pay off his credit cards. He was able to get 5%. The average credit card rate is 17% unless you've missed payment, where it could have grown to 30% or your credit isn't that good. So he's saving 12% a year on $25,000. What's 12%? I believe that's $3,000 a year he's saving. So he's paying 5% here, and on his furniture's credit line, and he's saving 12% off of his credit cards. $3,000 a year. Equity lines are the cheapest form of financing out there for the consumer. Prioritize your spending. What's really important to you? Do you need that golf club, or should you put that money towards fixing the car? Stop using your credit cards. I take a little bit of issue with this. We're going to eliminate your mortgage debt. We're going to show you how to get out of all your other debts. Here's the kicker. If you don't use your credit, you lose it. If you don't have credit, the cost of credit goes up. So let's say you retire, you sell your home in the Northeast, and you want to move down to Alabama where you can get a lot more home for the same money. But you don't want to pay cash for the house. You want to borrow the money. That house, if you have a zero credit score, you don't have a credit score, that interest could be what, 8, 10%? And interest rates are going up now. So even if you're just buying bread and milk and paying it off, use the credit cards for small amounts, but pay them off every month. Don't spend on things you ordinarily wouldn't have spent on anyway. Don't say, well, I've got a credit card, I can get away with this. Be very careful, but just maintain your credit scores. Devise a well-conceived, coordinated action plan using these and many of the newest wealth-building strategies today. The newest wealth-building strategies, an expert in that is Ed Slott. Anybody familiar with him? Some of you. For those who aren't, he's got videos all over YouTube. So look him up and see what some of his wealth-building strategies are, and we can help you with some of those. But again, this is an educational seminar. We're not trying to sell you anything, just informing you. But check out Ed Slott. Now, if you save the credit card interest of $2,400 per year, in 10 years at 7.2%, that would have been $24,000. You'd have basically $13,000, $14,000 more left over because you invested at 7.2%, And yes, that 7.2% is attainable. In 20 years, that's $125,000 you'd have. It would have been $48,000 you put into it, and you're approaching 3 times your money. The longer you leave the money in compounding, the faster it grows. In 30 years, it would be $294,000 off of $72,000 that you put in. So what is that? That's almost 4 times the money, because you let it ride for 30 years. Which way do you feel more financially secure? Saving that money and making the interest on it, or giving the money to the bank and not having anything left over? That's the thing about interest. It doesn't really buy you anything except the time that you save in getting something. If you save up for it, then you actually wind up with more. So where do you feel more secure? Having $294,000 or having paid the bank over all those years? And here are a couple more smart money moves. What if you could find more money and limit your debts by put into savings by increasing the deductibles on your homeowner's insurance, auto insurance, health insurance, disability insurance? This is going to be somewhat personal. You have to realize if you're accident prone, you're going to have claims, and then that's going to go up. Health insurance, if you're accident prone, don't go skiing so often. Just that joke about when you see somebody sitting there with a broken leg, but it all costs you. But if you're fairly healthy and you're fairly secure and cautious, yeah, this makes sense. Repositioning your assets and income to qualify for free college financial aid money. Financial aid is calculated on what you have and how much you make. And there are ways of structuring your finances to put your money into things that are not counted for in the calculations for financial aid. Taking advantage of the free money in the 401k. It's hard to beat a 50% return nowadays, and that's what you get with the 401k when your boss puts in that 50% match. But you shouldn't really put in past that. But you should take advantage of that, get that 50%. And there's something called a 1035 exchange that I'm looking into, that you might be able to take this thing, the money out of there, and put it into, let's say, a Roth or some other type of an account without having to pay taxes on the gains. So we're looking into that. I would consult with your CPA what a 1035 is, if it will work, and I'm looking into that as well. Reducing your income taxes. And there are definitely ways of doing that. Like, for instance, you don't want to pay taxes on your retirement, do you? It can get even better. Become your own banker. How about the next time you decide to buy a car, a refrigerator, a sofa, or need money for a business opportunity, that you borrow it from yourself? Where's it better? We've already shown how giving money to the bank is basically flushing it away. And it's not just the money that you give them that you're flushing away. There's the opportunity of the money, the interest that you could earn on it. Well, what if you wound up paying yourself back the principal and interest you would have paid to the bank? How much faster does your money grow? We've shown you a couple of ways to save money already. You're putting that money away. Instead of borrowing from the credit cards or from the bank for that new car or for the refrigerator, you borrow it from yourself and you pay yourself back a nice interest rate. How much further ahead would you be? And best of all, with proper planning and guidance, all this can generally be accomplished without you spending a penny more than you are spending today. And we've shown you some ways to do it, and there's more. Now, Albert Einstein gives us the key that really helps it make this work. He's a big proponent of compound interest. And let's take a look at that and see what it can do for you actually. Now, I've mentioned I'm not a big fan of income taxes. Let's say we get you a rate at 8%, and that is attainable. After 25% tax, that's 6% a year that you actually get. Now, let's say it's for 10 years. I used $5,500 because that stuck with me at the moment that I was doing this particular calculation on the computer. $5,500 is, until you're 50, the maximum you can put into an IRA or a Roth. It actually goes up to $6,500 after age 50. But the interest rate is 6%, and you're going to put in $5,500 a year. Basically, what you're putting in is $55,000 over 10 years plus the initial $5,500, $60,500. You're going to have $82,000. That's interest of almost $22,000. Extra money. Where would you rather have that money? In your pocket or the bank's money? Now, let's take taxes out and see how much better it does for you. Same, except for no taxes, so the interest rate is 8%. Same $60,500 going in, but this time you've got $31,000 in interest. That's about $9,000 more interest than if you paid the taxes. So don't you think we really need to learn how to avoid those taxes? And just to make the example, 30 years, everything else being the same, it's $678,000 in your pocket. Now you've made total deposits of $165,000, and the starting amount was $5,500, so that's $170,500. Now divide that into a $508,000. You've got 4 times your money in interest, actually 5 times your money, just because you let this ride for 30 years. Now, how much more financially secure you'd feel having this extra $678,000 in your pocket? What can you do with that? Pay off your mortgage and still have money left over. So let's take this a little bit further, see what this does for you. At this point, on average, this is generating about almost $50,000 a year in income to help this grow. And this is only an average. The return does vary. That's a $678,000, but you're getting that $50,000. Now, how many of you are more concerned about which? Outliving your savings retirement, or your retirement savings, or dying? Which are you more concerned about, dying or outliving your savings? I think with the answers I'm getting, with most of you saying you're more afraid of outliving your savings, you heard the stories about old women living off of cat food. With this, do you think you're going to have to live off of cat food? That's only an average, so, spend a little bit less. There's going to be inflation. There's going to be emergencies, so you're going to draw down a little bit. If possible, maybe you want to let it ride for an extra couple of years. You can see how over the past years it grew by $3,000 and $4,000. So let's say right now it's up to growing by about $5,000 over the next 2 years, $60,000 in income. And this is tax-free because you're borrowing from this plan. So on a loan, you never pay taxes. So this money has accumulated tax-free, and you get to use it tax-free. Now, basically what we're doing is we are investing in the market. But the market has risks. It goes up and down. Now, this goes over the crashes since 1901. Who here was alive in 1901? I'm not seeing anybody. I guess you're realizing that's too obvious to even answer. Let's go back to 1987, that crash. Who remembers what caused that crash? Yep, a few of you. Black Monday. That Monday, the S&P went down 600 points, and the next day went down 200 points. It took 3 years to recover from that. So in 2 days, we lost 36%. It took 3 years to recover from. 2000. What crashed then? Yep, the tech bubble, the dot-com bubble, big crash, 32%. It took 6 years to recover from that. Now, this is not a complete story, because where were most of the dot-com bubble stocks? They were in the NASDAQ. The NASDAQ dropped from 5,048 to 1,114. That turned out to be a 78% loss. Ouch. Now, it took 6 years to recover, but did we really recover in those 6 years? Because then we had the housing crisis, where we lost almost half of our money. It took 5 years to recover from that. So we still haven't even caught up in, let's say, 5 plus 2008, 2013. We just started catching up in 2013. But on average, it was a loss of 47% every 11 years. Now, how does that hurt the performance of your investments? What if you could limit those losses? What if there was a way not to have those losses when the market crashes? Losses can be controlled by a cap and floor. Does anybody here know what a cap and a floor is? Some of you. Okay, well, we're going to let the rest of you know. You can have no market loss with a cap and a floor. Let's say the market goes up 22 years. Now, the plan you're in caps your gain at 10 to 15%. So you're losing 7 to 12% of your gain. Now, that sucks, doesn't it? Yeah. But what if you're getting something better back? A guaranteed zero loss when the market crashes. Now, here they use an example, 25%. But from the chart we were looking at before, you could see that the smallest loss was 32%. If you actually looked at the NASDAQ, also it was much more. If we go back to Black Monday, 36%. So what would you rather do? Give up 7 to 12% to avoid losing 32%? I would. And it seems like a bunch of you would too. Now, what if it's someplace in the middle, like the market goes up 8.5%, you get the full 8.5%. Now, let's see how this works in practical terms. Here we've got that dot-com bubble where in 2000 it dropped by 10%, 2001 13% of what remained, and 2002 23% of what remained of that. But you had in an IUL no losses, a guaranteed floor. So what happened? With the crash, if you just had a money market, you would have dropped down to being worth under 60,000 if you start with 100,000. But here you would have maintained, you would have had no losses. You'd still have the 100,000. And when the market starts going up, you share in those stock market gains. Whereas here you're playing catch up, and you don't catch up until 2008, and then you have another crash. And this one's that 50% crash. And by the way, what kind of a return do you have to make up your money from a 50% loss? The gain has to be 100%. And it takes a lot longer, as we've shown, to make that money back. So you don't really come back to even until 2013. Whereas all this time you're going up. So at 2013, you've made the money back. You've come up with about $25,000 in profit. Your annual return would have been 3.54%, and it would have been taxable. With this, if you want to take and this is all assuming no trading, you just let it sit and you let it grow. You let it go. Now with this, it's compounding at an average rate of 7.92% during this period of time, and it's tax-free. The example we use here is an IUL, And basically, here you've got $25,000 gain they have to pay taxes on, so you're left with a bit over $18,500 in gain. With this, you've got over $141,000 in gain. Which do you feel better about having? Which makes you feel safer? Now, with that, it's much easier for you to take the money out and pay off your mortgage when you've accumulated the money. But what if you make an extra payment? Won't that pay it off faster? Well, yeah, but what else happens? What if you become sick, disabled, laid off from your job? Is the bank going to give you any of your money back? No. But you've got that money that you've been saving and investing. With this strategy, you could pay off your mortgage or withdraw it as a paycheck from your policy until you get back on your feet. And we strongly recommend that you pay it back so that your money grows even faster, so that you're ready for your retirement. Which option do you feel safer with? Making that that extra payment, making larger payments, or having it growing for you so you have more money left over and you're set for that? Basic concept is never give the money to the bank that you don't have to, and to earn money off of that, and you can see how much better off you would be. That's been the presentation. Again, my name is Scott Suss. I am with Virtual Financial Group. We specialize in living benefits. We help you achieve your goals and overcome life's obstacles. I'm sorry I don't have any time for questions right now. We've been on this for a while. If you'd like to ask any questions, you can call me at 484-523-3788. If I have time, we'll answer the questions then. If not, we'll set an appointment for when I can give you the time that you need. I'm leaving this up for a few minutes, but this is basically it. And I hope I'll see you again and hear from you again, maybe at other webinars that I put together. Thank you for your time, and have a great rest of the evening. Bye-bye.